Welcome to the Trading Justice Podcast, everybody. Today, we're diving into a really important topic that's on the minds of every American right now as that debt debate is happening in the real time. And so we're going to talk about debt here today. How did we get to the point where we have $37 trillion in debt? How did we get to the point where we go into debt $2 trillion every single year? How are we having a debate where we're talking about raising the debt ceiling by $5 trillion and going into more and more and more debt? Debt. America is addicted to debt, and we're going to have a conversation about that here today. And my perspective on it is really, really simple. The solutions can be complicated, but I think it's important and equally important to understand how we got here. Because if we don't have the conversation of how we got here, it's going to be very difficult to actually have a conversation to create a plan to get out of this mess to where we're spending more than $1 trillion on interest payments on that debt service every single year alone. So Mark and I, we decided, let's talk about debt today. America's addicted to debt. They're talking about debt right now. The big, beautiful bill is going through Congress right now. So we're going to have a little bit of a conversation, and we're going to walk you through from the economic evolutionary perspective. What did we start with? How did we get here? Where are we going? And then we're going to talk about those next steps and how it impacts the market moving forward. With that said, Mark, very quickly, ladies and gentlemen, I almost forgot. I get excited when we would talk about economic history, Mark. I get excited when we talk about these fiscal conversations. I do have a Master Trader course coming up on Monday, 7 p.m. Eastern Standard Time. It's going to be an amazing class. We're going to spend a good 3 hours talking about technical analysis, trends, patterns, support, resistance, indicators, secondary confirmation. We're going to learn how to find trades, prep trades, place trades, manage trades, all of that, Master Trader. But Monday is only the first session. There's 3 more sessions in the on-demand itself as well. We'll cover that on Monday during the Master Trader. And if you want to join Master Trader for this month, all you have to do is hit the link in the description below, and you can sign up there on the live events page. With that said, Coach Mark, how you doing today, my friend?
I am really excited about this conversation, not just as a participant in this podcast, but as a consumer of information. I find that these macro conversations that are at the center of things, they have more market implications than people would like to believe. And understanding the world you live in, and I think you're going to have some fascinating takes. And talking to you before the podcast, I know you are. It is going to give you an understanding of the current headlines better than anywhere else you go. And I want to dive in from that because, Matt, we have a lot of headlines right now: debt crisis, people taking different cases, right? We've seen Elon Musk, Rand Paul, certain, very well-known actors in the political and economic sphere say that there's issues with the bill and the spending. Those get headlines. Other individuals have different takes. But I like where we're going on this journey. And we'll get into some of the nitty gritty of what's going on today and the market implications here in a few minutes. But I love in talking to you about this subject before is like, listen, unless you really understand where all of this started, you can't have a true understanding beyond the surface level of what is happening today. And I want to start with that journey. That's almost at $37 trillion, right? By the time this podcast ends, it might hit at this rate, $37 trillion, right? It's an astronomical number. You can't even conceive really how big this number is.
Mark, I once was teaching a seminar, and I brought up the debt clock, and I made a bet with the class. There's about 50 people there, and I made a bet with the class that if I was right, I'm done an hour early today. It was like a 10-hour day, right? And if I'm wrong, I'll go an extra 2 hours. So I gave them a 2-to-1 transaction, basically. And they're like, oh, all right. And I set the number, and I said, okay, is the debt clock, and I'm going to keep the debt clock up there for 2 straight hours, right? I'm going to keep the debt clock up there. And if we surpass X amount of debt. And I made the number outlandish, like in the billions. Like in the next 2 hours, we're going to go into debt $50 billion. And everybody's like, no, no, no. Mark, it was like 280 billion. It wasn't even close. And I'm like, guys, when you think about this as an individual, like, I don't think you can comprehend the amount of debt we're talking about, the amount of debt that we go into every second, every minute, every hour, every day, every week, every year in America. And at this point, we're now spending over $1 trillion in interest just to service the debt. Now, some of that interest goes to Americans, some of that interest goes to the central bank, some of that interest goes to Wall Street. But a lot of that interest goes outside the United States to foreign countries that own our debt, and we have to service on that debt. And that debt is now one of the number one costs for America, just the interest on the debt. This is not a sustainable path moving forward. And that's what a lot of the criticism of the current way we handle these conversations. I'm not specifically criticizing the current budget bill. That's not what I'm talking about. This is not a conversation that is just this year. It's been an issue for the last, quite frankly, 45 years. And so for me, it's equally important to understand how we got here.
Yeah, I know.
Because
And
if
let's
we
get
can
into
understand how we got here, we can start to understand how we get out of this situation as well.
and
And
more importantly, the ramifications if we don't
yes,
get out, right? If
yes.
we get out, let's get in that hot tub time machine, Matt. Let's go back to 1980, because understanding where we're at and the policies in place, and making an educated guess if we can get out or not, you believe started in 1980. And I want you to start us on this historical journey on how our addiction to debt, our view of debt, kind of had this origin in 1980, and talk to us about the evolution as we have gone through the last couple decades.
Well, 1980 was a very important date. There's no doubt about that. But when you're talking about the original understanding of this conversation, it goes well before 1980. This conversation, the epicenter of this debt conversation and our fiscal belief system in America and our economic philosophy as capitalist in America, and all of that goes back not to 1980. It was not birthed with the neocon movement of the 1980s. I can promise you that. It was born out of our understanding of the social contract, Mark. And that's something that doesn't get talked about a lot. But the social contract is basically, when you think about the original philosophers of John Locke, Henry Rousseau, Thomas Hobbes, and whatnot. John Locke, for example, was extremely influential on our founding fathers, extremely influential on economic philosophers such as Adam Smith, who wrote The Wealth of Nations, which basically influenced our founding fathers from an economic philosophy. But it really goes back to the social contract in having an understanding of what do we agree upon when we come to this world, and what does the government agree to? Because, Mark, our founding fathers and people like John Locke and the social contract theorists believed in what was called inalienable rights. These rights that all of us have as we're born in this world, as we come to this country, and they are inalienable rights. They are natural rights. They are gifted through God, or however you want to categorize that social contract. And so these are inalienable. They are natural rights that cannot be taken. They have to be given. And what we give to the government is we get basically agreed to live by the rule of law, and we agree to be a good citizen, and all of that stuff. What the government agrees to, if we're going to give up certain rights, right? What the government agrees to is to provide certain things. And in the original version of America, capitalism, economic philosophy, what that was government agreed to basically provide a defense for the nation, as well as security for internal, as well as infrastructure. Those things benefit the net as a whole. And basically the entire economic philosophy was one of small business creation, really kind of drive that small business creation. And Mark, those simple philosophies, the lines in the sand between government and our rights, government and those inalienable rights, were pretty set in stone up until about 1930. And in 1930, the economic system evolved. And through that evolution, you had the birth of Keynesian economic analysis. And if you don't have an understanding, like you can have an understanding of this debt crisis, and you can have an understanding of what's going on with our debt crisis and what's the answers moving forward, if you have an understanding of Keynesian economic analysis, which is a dominant form of economic belief system. That was not in 1776, 1787. That wasn't 300 years ago with John Locke. That was in 1930. And when you're talking about the evolution of capitalism in our American economic belief system, it's really told through the lens of the negative moments in economic history. Because in good times, people don't change things, Mark. In good times, we just go on. We just live our life. We do our thing. We complain, but we do our thing. But when times get tough out there, we as a people have a tendency to want to solve the issue, fix the problem. And in the 1930s, there was an economic philosopher by the name of John Maynard Keynes. And in 1936, he wrote a book regarding this philosophy of Keynesian economic philosophy. But what he said was, in times of economic crisis, according to the social contract, the government has a responsibility to the people. And in the 1930s, when you're dealing with 28% real unemployment, and you're dealing with people who can't even put food on the table, and we're dealing with economic starvation, there's a problem with capitalism, according to Keynesian economic philosophy. And that problem is there's no demand. You have constant supply, but there's no demand. And so what John Maynard Keynes argued was that it's the government's responsibility to step in and provide assistance, support to the economic system as a whole. Now, that philosophy is a dominant philosophy from the 1930s till today. That philosophy is dominant, but it's really important when you think about how Keynesian economic analysis is applied in these conditions, because from 1930 to the 1970s, it was applied through bottom-up analysis. Now, what that means is, from an economic philosophy theory perspective, you can either target the top of the market or you can target the bottom of the market. Now, most people think capitalism is a top of the market philosophy, where we stimulate the top of the market succeeds, and they will trickle down everything to the
And they
bottom of the
think that
market.
because most of our adult lives, that's how it's been, right?
Well, that's how we grew up in. We grew up in trickle down economics, but really it was the neocon movement. But Mark, that's not the original version of capitalism. The original version of capitalism up until 1930 was bottom up. You wanted to support small business creation. Even in America today, small business creation is a major driver of economic growth in America. And so in the 1930s, what did we do when we birthed Keynesian economic analysis? Is we basically stimulated the bottom of the market. How did we do that? How did we get money to the consumers to start increasing spend? What was the things we did in the 1930s, Mark?
Well, we did all kinds of social programs in the 1930s in order to, right, going through the Great
Birth
Depression.
of the social infrastructure, right?
And so tons, like just this
Social
massive
security,
wave
infrastructure projects, you name it, right? Well, Mark, what that is the birth of the Keynesian economic movement, is what that is. You have direct stimulus that will stimulate the bottom of the market. And as the bottom of the market gets, and who is the bottom of the market? It's consumers.
It's me, it's you, it's all of us.
It's all of us, right? And who's the top of the market? Wall Street and the big corporations, right? Well, if you stimulate the bottom of the market will have demand. And that's what Keynes argued, is in economic crisis, the supply is not the issue, demand's the issue, and the economy will never improve until you fix demand. but you're never going to fix demand until the consumer gets confident, because the consumer's scared about putting food on the table. And so what Keynes said is, we're going to provide jobs for people to build infrastructure. So people got a job, they started getting money. That money started going into circulation. Velocity of money increased, and all of a sudden you had an economy that was now growing again, because consumers had that job, had that money, and was spending that money into the market. Now, to me, in times of economic crisis, it does make sense that there are some flaws with the original version of capitalism. And I say that as an Adam Smith disciple of Wealth of Nations. And there are some flaws in capitalism with the original version of it, in the sense that I'm not sure Adam Smith envisioned a multi-layered global marketplace where you weren't just dealing with closed economic systems and just dealing with individuals in that closed economic system. So obviously things have to get modified over time. And that's what you saw in the 1930s, was that modification. That was the first real evolution of economic theory in America. And here's where the debt really starts talking. It was not an issue up until this moment. And then when you started stimulating the bottom of the market, how do you do that? You do that with money, by providing jobs. How do you get the money to provide the jobs? You go into debt. And that's where the theory starts to become difficult, because it makes sense for the US government to help the economy in times of crisis. But you have to go into debt to do that. Now, what John Maynard Keynes argued was, after the debt is serviced and after the economy starts humming, you have to do austerity measures, because in times of growth, you don't need to stimulate the market. You need to take some of that growth and pay down the debt, so that you aren't basically hamstrung in the future because you have too much debt. Now, that's probably where John Keynes loses me a little bit, because in our political system is not created for austerity measures. We don't have term limits for something along those lines. Now, that lasts from 1930s to the 1970s. And so I know you wanted to start with the 1980s, but you really can't just start with the 1980s, because if you just say, well, the neocon movement in the 1980s started doing this, well, you lack the context for the original version of capitalism.
Right.
You lack
So
the
up into
context
1980,
for the modification. And the number one modification in world history economically is the 1930s, with the birth of Keynesian economic analysis.
and so we head into 1980. We basically have an economic system that feeds the bottom. We saw this, throughout the decades. But that changed in 1980, right? That changed in 1980. And where was the debt level as we headed into 1980?
Well, it's not necessarily the debt level at that point. It's because it's really about debt to GDP. If your GDP of America is $57 trillion, $36 trillion
Doesn't matter.
isn't that big of a deal. If your debt burden in America is 37 trillion and you have a $28 trillion economy, you're running a deficit, and that's a problem. And that's where we're at, right? And so it's really a matter of the debt to GDP ratio, which is over 120% as of right now. Certainly wasn't the case in 1980, but to come back to understanding the evolution of 1980 and the neocon movement that really kind of impacted that is the 1970s. Keynesian economic analysis, the major flaw of Keynesian economic analysis, it will spark inflation over time. There is no doubt about that, because where's the money going, Mark? The money is going to the consumer. And when you have direct stimulus to the consumer, you have the immediacy of volatility, i.e. velocity of money. And when you understand inflation, it's not necessarily, I don't want to disagree with some of the amazing economic philosophers of the past, like Friedman, for example, who coined the term helicopter checks and talked about inflation through the lens of deficits and M2 rate. And if money supply goes up, well, inflation's going to go up. That's not necessarily 100% accurate. It depends where the money goes. And when Friedman made that comment in the 1970s, we were under a Keynesian economic model, which meant all stimulus in economic difficult times went to the bottom of the market and created inflation. And that created the stagflationary environments of the 1970s, where you basically were stagnant from a growth inflationary perspective for an entire decade. And the 1970s was that economic decade that was kind of the equivalent of the 1930s, right? From a stagflation perspective versus a growth scare perspective of the 1930s. But once again, an equally important understanding here is we changed the economic situation. We changed the evolution. And what's important here of the 1980s is we didn't change Keynesian. That's what people think happened, is that the neocon movement didn't just modify the Keynesian economic philosophy that dominated in America, our central banks, the government from the 1930s all the way to the 1970s. They didn't change Keynesian, they applied it in a different way. Remember, when you think about Keynesian economic analysis and stimulus, you can either stimulate the top of the market or you can stimulate the bottom of the market. And what Friedman, Hayek, and Ayn Rand before them, Alan Greenspan at the central bank, Paul Volcker, and political leaders like Margaret Thatcher and Ronald Reagan, who led this neocon movement in America, Great Britain, and around the world, quite frankly, in the 1980s, basically what they said is, we can't stimulate the bottom of the market anymore because it's creating inflation, stagflation, and we have to do it a little bit different. It's not that we're going to not increase the M2 rate. It's not that we're not going to increase debt. That's not the equation. It's where does that go to? The belief started changing. And instead of stimulating the bottom of the market to create bottom-up economic philosophy and thus velocity of money, what they did was they started stimulating the capital side of the market. See, the bottom side of the market is called labor, right? And the top of the market is called capital. And so under pure Keynesian economic analysis, you stimulated the bottom of the market to create velocity of money, and thus ultimately it would go to the top of the market. Well, what the neocon movement says is, nope, we're not going to do that because that created the stagflation of the 1970s. We had too much money, and that money was in the hands of too many people. And when you have too much money in the hands of too many people, it's going to create inflation. And the velocity of that inflation is going to expand greatly. And so what they say is, well, let's just not give it to those people. Let's give it to the top of the market. And if we give it to the top of the market, you're not going to see, you can put the exact same amount of money. In fact, you can put 10 times more money into the economic system if it's in relatively few hands. Because the one thing people do not get about this inflationary conversation is inflation is not simply because you increase the M2 rate like Friedman talked about in the 1970s. And again, I think Friedman would agree with me if he was looking back 40 years later, quite frankly. But it's not just the M2 rate. That's one part of the calculation. If you have $15 trillion of money in a system, but 14 trillion of that dollars is in the hands of 3% of the populace, and 1 trillion is in the hands of 97% of the populace, you do not have velocity of money. You don't have utilization of money. You have to, and so basically inflation comes down. You could have less money in the economic system, but the greater percent of that in the hands of the majority, and you would have greater inflation.
And the graphic example of this, to put it to examples everybody can understand, is what did we do in COVID, Matt? Right? We don't have inflation for a decade. We don't have an inflation for 15 years. Because
but to understand that, see, that's the thing I've seen a billion times in the last 15 years. Why is it in the 2010s, when we put more money in that decade of new money into the economic system, and it was not just in the US, it was global supply increased at the same rate as the US supply. So Mark, let me ask you a question. Why is it from 2010 to 2020, that decade, we put more money into the system but had less inflation?
Well, you just explained it if you were paying attention in the podcast, right? that when you give it to the top of the market, when you give it to capital instead of labor, the velocity of money
Inflation
through the
doesn't happen
system,
because Goldman Sachs has money in a bank account.
it doesn't. And this is one of the things when somebody's out there, well, we're printing so much money, it's going to cause inflation. No, you just laid out why that isn't the case. But what happened? So when we, in 2010 to 2020, right, the velocity of money is not
Well,
accelerating, thus the
to
inflation.
understand that, though, and again, this is very important to me. It's not going to be important to everybody. Most people in America just want to be told what to do. It's important for me to have our community understand how we got here. And you simply can't go from 1980 to 2010 without understanding the concept of modern monetary theory. Because, Mark, the 1980s is when we changed our philosophy of Keynesian. We still apply Keynesian economic philosophy, but from the 1980s on, it was not applied to the bottom of the market, it was applied to the top of the market. So from the 1930s to the 1970s, it was applied directly to the bottom of the market. From the 1980s to the 2010s, it was applied to the top of the market. So the difference is, where does Keynesian get applied to? Does it get applied to the bottom and thus stimulate growth, or does it get applied to the top and stave off recessionary analysis? Now, what happens about 12 years later is very important. You had an author who wrote regarding modern monetary theory.
And 12 years, what year does that put us in?
This puts us in the mid-90s, basically.
Mid-90s, okay.
This is right after we started seeing Japan kind of collapse in the late 80s, early 90s, and we started seeing some Asian economic crisis, and we went through a recession in 1991, 1992. And basically, the philosophy of modern monetary theory is this. I'm going to make this one really, really, really simple. Modern monetary theory believes that they can create an economic environment where there will never be a recession. Okay, that's the entire base of the philosophy. We're going to create an economic environment that will never have a recession. Now, Mark, was there some leaders in our history that said we're never going to have a recession again?
Well, Janet Yellen, I believe, in a few years back,
2016.
said
2016 made that.
I think she even said went so far to say we'll never have an economic
crisis. So let me ask
crisis
you a
again.
question then. Why does the modern monetary theorist believe that they have the ability to create an economic environment that will never have a recession without creating hyperinflation?
Because
what is the epicenter of that belief?
Well, it would be, and I don't know if this is 100% correct, but based on everything that you've laid out here, it would be they believe they have the ability to put money at the top of the market, right? Top of the market, to basically create whatever environment. So if you are coming down in economic net numbers, that they can insert the capital through whatever means they need to basically juice the economy from kind of that top-down perspective.
Because their belief system is they can throw an unlimited amount of money at the issue without creating inflation, because it would be into the hands of relatively few, i.e. the top of the market. And the top of the market will trickle down what the cost of living is, which will not spark inflation. And so that's the philosophy. We will constantly funnel money to the top of the market. We will constantly support the banks. We will constantly support the corporations. We will constantly support the top of the market, and they will trickle down the average, cost of living to America from the 1980s till today. And that's the philosophy. And it was adopted in the early 2000s in Japan. But in 2008, that philosophy, Keynesian economic analysis, stimulate the top of the market, kind of forget about the forgotten man in America to a certain extent. That really was put to the test in 2008, Mark, where you had the subprime meltdown. And what was our response to the subprime meltdown? It was unique in the sense that, unlike the 1930s, where we created job programs and built infrastructure and social safety nets, unlike that, we started stimulating directly to the top of the market. We bailed out the banks. We bailed out the corporations. Government legitimately purchased entire corporations. They bought Sallie Mae and Freddie Mac, the student loan and insurance conglomerates, right? We saw all these companies like from Bear Stearns, for example, to Countrywide to go out of business. And we started seeing bailouts galore, right? Trillions of dollars in bailouts. And then over the course of the next decade, what did we see? Every single month, month after month after month, billions upon billions of dollars, where we put trillions of dollars of stimulus into the marketplace. But where did it go? It went to the top of the market. Wage growth lacked all of that. So despite the fact that we were seeing record amount of growth in the market from an M2 rate, a debt perspective, it was not creating inflation because it was not in the hands of people. That's the epicenter of the modern monetary theorist. That is the epicenter of my disagreement with the modern monetary theorist, is they believe they can constantly stave off recessions by constantly supplying the top of the market with money. And as long as they supply the top of the market with money, they're never going to deal with inflation. And they were right. And they are right. I don't agree with it, by the way. I think it's disastrous to 90% of our world. But to the people that get the money, it's really good. It doesn't spark inflation. I don't remember a soul complaining about inflation in 2013, 2014, 2016,
All of the
2018,
conversations you and I
2019.
traded, you and I were, doing this the
It was
entire
never an
decade.
inflationary
In fact,
conversation.
deflation was always the topic du jour.
Okay,
when
deflation, and yet the M2 rate was doing what? So the M2 rate was skyrocketing, but the level of inflation was flatlining.
In fact, they wanted, the debate was, we need to pick up inflation a little
bit. Was Milton Friedman wrong then, who said inflation is a direct component of the government spend and stimulus? Okay, we saw that in the 2010. So what would Milton Friedman say? The same thing everybody else says on this topic. As long as you put the money at the top of the market, you can have unlimited supply rate, unlimited debt, without the biggest risk in the market, i.e. hyperinflation. Well, Mark, that changed in 2020. And in 2020, with the pandemic, our response was, well, in the 1930s, we supplied the bottom of the market. In 2008, we supplied the top of the market. This time, we're going to do it both. And so this time we did it both. We did the helicopter check money in the early pandemic. We did multiple stimulus of direct checks to people. And when you put direct money in the hands of people, what did we see? 8% inflation, 9% inflation, 10% inflation, because now the money's going directly to the hands of the people. And that exploded our debt. So when you want to talk about how we got to this point of debt, where we deal with nonstop debt explosions and we're dealing with inflation, guys, we can yell at each other as humans and Americans over the politicians who made these decisions, but this is a design issue. The entire system is designed this way. It's not just one president or one central banker. It is a design flaw in our system. And if we're ever going to actually start attacking our debt, we need to start having this conversation of total money supply and where that total money supply is going. Because when you think about the solutions to our debt, well, we talk about austerity measures, and we talk about, in the big, beautiful bill, we talk about the debt limit being raised, and we talk about all these minor issues. Mark, it's all part of the same flaw within the design of the system.
It's just would it be fair to say that the big, beautiful bill, right, for whatever, and let's get at, is just a continuation of the same system that has been going on?
There's not one thing different
years.
in the big, beautiful bill versus what we've seen out of budget plans over the course of the last 15 years in the market. It's a continuation of the exact same conversation.
All right. And so when somebody like a Rand Paul comes in and says, I don't like this because of X spending, they never address the system itself. They just say, we got to control. I mean, we get a lot of sound bites, Matt. We get a lot of, we got to control our deficit, without laying out, like,
like Rand Paul has the conversation through the deficit situation, saying, listen, as long as we run this deficit, like I said, Mark, you can, the debt itself is not the problem. Like we get so fixated on $37 trillion in debt. Once again, you got a $75 trillion economy. That's not a problem. The problem is the fiscal deficit continues to increase, and the debt to GDP burden continues to increase as well. And so what Rand Paul's saying is we got to attack the spend issue. We spend $2 trillion every single year, more than we take in revenue. And so Rand Paul takes it from a spend perspective, whereas others might take it from a tax perspective. My thing is, we have to have the conversation a little bit bigger than that from a design perspective. But I don't have any disagreements with Rand Paul regarding, hey, we got to be more fiscally conscious here. We do need to be more fiscally conscious here. We cannot run 2 trillion deficits every single year. We cannot continue to go into hundreds
And
of
why
billions
can't
of
we?
debt. Because why can't we?
Big
Because
conclusion. Why can't we? Not
why
that it's
can't
the
we?
conclusion of this
Because the
conversation.
debt, $36 trillion of debt, isn't on us. It's on my kids. It's on your kids. It's on their generations. Why are we living this world if it's not to produce a wonderful legacy for our kids and their grandkids and their grandkids? It's because we believe in the American dream, Mark. From the very beginning of the founding of our country on, we had this core belief in the American dream that anybody from anywhere could pick up their bootstraps, lace them up a little bit tighter, go out there, work their ass off, get the job done, and create a legacy for themselves. If we don't fix this debt problem, you are killing the American dream. And we are seeing that in future generations already. My generation grew up with the belief in the American dream. You grew up in the same generation. Every generation before this current generation grew up with the belief system that we can do better. We can do better as an individual. We can do better as a whole. We can do it through our hard work, our principles, and all of that. But Mark, when you have a situation where all these generations, they can't even afford to buy a home because the service on the debt is so outlandish. You want to talk about lowering interest rates? How in the world is the central bank going to get into a 2% interest rate environment if debt goes up, 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 up? You got to get more fiscally conscious here. And so to me, if you want to talk about the biggest macro risk here, it's the killing of the mentality of the American dream, where people don't feel like they can create economic value on top of
And
the
we know
previous
this, like
generations.
there are the stats are obvious. The gap between the top 1%, the wealth inequality gap is something that is noticeable, and it's a byproduct of this system, isn't it? The one that started in 1980 that you have outlined, that's
Mark,
created.
it's really simple. Why is it in 1980 we had a 30-70 rule? 30% of the populace controlled 70% of the money. Today, 3% of the populace controls 97% of the money. That's not because 3% is so much better than the 97% mark. That's not it. It's not like that 3% was just so much more intellectual and had so much more creative ability. It's not that. It's that we changed the design of the economic system in 1980 to do specifically that, to create the M2 rate to be in the hands of the top of the market so that they, i.e. the powers that be, can constantly supply the money to the market without creating too much inflation to the people.
All right, I want to shift gears just a little bit,
Yeah.
stay on the same subject. Jamie Dimon recently has talked about, there's been a lot of people talk about the debt and the deficit and the market implications. And this, and we don't have time to go into my own bear market theory, why I'm
Oh,
so
I could go on
bearish
this conversation for hours.
for the coming years.
Yeah.
But, the servicing of the debt, right? And you made a little reference, but as I want to highlight it, we pay more in interest payments on our debt than we do for the defense budget. Right. I think the interest on the debt is north of $1 trillion. That's not what the annual defense budget is. Right. And that particular element is really problematic. Now, there is a particular issue, and Jamie Dimon has really not shut up about this. And I think you think Jamie Dimon tends to be a little dramatic at times, but this is one of those times he won't back off, because normally Jamie Dimon comes out and says something and then you don't hear from him for 2-3 months, right? Says some apocalyptic thing, hurricanes are coming or something like that. he won't shut up about this recently, and I think for good reason, where he says, listen, you've had excessive government borrowing and spending post COVID, and a lot of that money was financed at very low rates. Now you have an
We had an effective zero
explosion,
interest rate policy for 10 straight years. So yeah.
and not only was that done on the government sector, it was also done on the private sector. Well, a lot of that money is going to need to be refinanced in the coming months, coming year, and you're going to have, and he says, and man, he is very like, listen, you are going to see a crack in the bond market due to the excessive government borrowing and spending as that refinancing comes due. And he said, he's like, you're going to feel pain. You're going to feel panic when that occurs, right? This is something that other people that I follow have talked about as a potential issue. I've totally bought in to it as a macro issue that could really impact the markets in the coming months. As well, if that's true, if you have all of this excessive money that needs to be refinanced, not only does it increase the amount of interest paid on the debt, but more important and practically from a market perspective, that's a lot of supply that could send up yields, which would put pressure on markets all over the place. I mean, what's your take on Jamie Dimon's recent, diatribes that I tend to strongly agree with?
I never get too caught up in Jamie Dimon's nightmare hurricane economic scenarios. I always try to read it through that lens. Jamie Dimon is one of the smartest men out there. He's one of the most intelligent, and he understands this conversation as well as anybody does. I think he uses a lot of his knowledge to impact policy to get certain things that he wants. And so I do see a lot of what Jamie Dimon says through the lens of what's good for Jamie Dimon and what's good for JP Morgan in general. And so again, I'm not trying to say anything negative about Jamie Dimon. I think he's extremely, extremely talented. I just think he manipulates things a little bit more than others do. But you've had a lot of other people out there, talk about the problems with the debt burden as well. Do I think it can create an economic hurricane situation where it saddles the American consumer with too much debt for generations to come if we don't get a handle of this? I do. Yeah, of course I do. I think it's extremely important to understand. I don't think Jamie Dimon, like if you're talking Jamie Dimon, like if he's thinking 3-5 years from now, I 100% agree with him. Like I 100% agree with him. If we do not get a handle of this debt situation, and if we do not fix the fiscal cliff that we are screaming to, we are going to end the American dream for generations to come. We are going to I always try to see economics, Mark, not where we're at. I like to see economics through the lens of where we were and where we want to get to, right? So economically, in 10 years from now, we're going to be dealing with a vastly different economic system in 10 years from now than we deal with today. We are going through probably the number one technological build out in human history with the AI development, robotics, automation, and so on and so forth. Mark, if we don't start fixing this problem here today, and we compound this problem in an age where workers are losing jobs because of automation, we are talking about saddling future generations with the problem that cannot be fixed. And before people start thinking about, well, Matt, what are you talking about? How it can't be fixed? Debt, interest on debt, the one thing in America that we have as a benefit, and one of the reasons we can do all of this stuff and other countries can't, is because we are the servicer of the world financially. The dollar is the reserve of the world. If the dollar ceases to be the reserve, this debt burden becomes a debt nuclear bomb, quite frankly. And there are legitimate conversations happening right now that over the next 5 to 10 years that we're going to lose more and more reserve status. You know my opinion, even if it wasn't for tariffs and the geopolitical situations happening around the world. Mark, this US dollar has been losing reserves since 2009.
You've chronicled how it's had a
going
slow
to continue to lose reserve over time, regardless of what happens in 2025. It's going to continually happen. And so as that happens, if we don't fix this solution, and in 10 years from now, we have $47 trillion in debt in an environment where you're dealing with a labor environment where I just think that creates an economic scenario where you could legitimately see the death of the American dream. And so we can either fix this problem right now, embrace AI and automation, and create a fiscally responsible economic system to where we all thrive in the future. Or two, we can yell at each other on Twitter and social media when we're all agree with the general problem. If we all agree with the general problem, let's try to find some rational solutions to this problem.
Well, and one of the reasons I have an extremely limited bearish outlook is I do not believe that will occur. Right. Like, and that's my pessimism and that's my glasses half full.
I agree in the short term. I'm a perma bull in short term, no doubt about it. But Mark, the thing about debt and reserve status is either you're going to get in front of this and you're going to fix it, or the rest of the world will put this on you at some point. And so that's what Elon Musk, that's what Rand Paul talked about. That's what Thomas Massey talks about, is the fact that it doesn't matter what happens in the future. If we don't fix this debt problem, we're going to saddle entire future generations with this issue. And so you're right. But Mark, you cannot constantly stimulate both the top and the bottom of the market. You're going to create hyperinflation over time. You're going to create a debt burden over time. You got to solve the issue. That is why I support the conversation in the big beautiful bill right now of, all right, do we have too much spent? Do we want to truly continue the same tax policy, or should we have a little bit more of a conversation on that? And so I just think we have a unique opportunity right now to start putting us on. No, not one president, not one human being, not one central banker is going to fix this problem. This problem has to be a belief from America in general to fix this problem. And I do think we have that ability. And that's why I think it's really important to understand the conversation coming into it, where we're at with that conversation. But as long as the design continues to be a design that is based on Keynesian economic philosophy applied in a modern monetary way, you're never going to fix this problem.
Yeah, and politicians that continue to advocate for the system that you have lined out beautifully. This has been a great learning podcast. We're in an increasing populist time period. You see that around the globe. It's not just here in America. It's that general public not big, huge fan of continuing the status quo. They want a little bit of bigger piece of the pie. So,
well, after 5 decades of a design flaw, that's going to creep in. That's going to creep in. There's no doubt about that. Right now, 65% of the American populace cannot afford any short-term pain economically. They cannot deal with it. We have to fix this problem. We have to fix this problem. And the way we have the conversation, I thank you for allowing me today to kind of go into story mode a little bit.
No, this is a podcast I wanted to do, so listen, I could reference.
I totally get it. I'm just saying, like, if we don't have the real conversation over this, and we just yell at politicians over little minor things within budget bills, we're never going to have the real conversation. And the real conversation is the economic design of this system.
I want to be very clear. I do not believe the modern politician will ever have this collectively. I believe the market will eventually force a very painful conversation on America.
Well, the modern politician will always vote in their best interest. I mean, that's base human nature. And until we have term limits, they're not going to put
I think like 35, 40 minutes ago, you identified the problem in the system. Right when this was started, right, it was a design flaw with the lack of term limits within the politician, and so I don't believe.
I think that was Keynes' number one flaw.
And so you go back 40 minutes.
Politicians.
The problem we have today is one of human nature and a lack of term limits that nobody will actually address the problem because it's not popular to do the things that might be necessary to do that.
President Trump talks about 1879. Okay. He brings up that date a little bit of times. That's when he kind of talks about his terror plan of the 1879, 1880, 1890s, right? He goes back and he talks about that time. What I would like to add to that time period is there was a reason there that time period is looked upon by some as an economic time period that we should think about. And the reason is, number one, it wasn't tariffs. That's where I do disagree with the president on, but I do agree with the time period there are things we can learn from that time period. To me, Mark, the number one reason that time period is looked upon is we had a fixed monetary system. We had a bottom-up economic approach in a fixed monetary system that was tied to commodities. That is the check and the balance on the government from printing too much money, borrowing too much money, because you have fixed M2 rate. And for me, it's not the amount of money that's the problem. It's where that money is. If you wanted to truly fix the subprime meltdown without going into too much debt, you should have taken 1/10 of the totality of stimulus, 1/10, Mark, 1/10, and put it into the hands into people. Because what that does is people spend that money, and that money goes further than one utilization. The velocity of money is what is really important here. Because if you can print unlimited amount of money and have no concern for inflation if there's only one utilization of that money, because it will never spark inflation. If you wanted to fix the inflationary situation of 2020 and not deal with the inflation we dealt with, reduce the spend by 90% and put it directly into the hands of people through stimulus program, certainly. But Mark, let me ask you one final question on this. I know you want to move on. When you give people money, and I don't believe in giving people money, I think you got to work for it. But when people have money, what do they do with that money?
Well, they spend it, they invest it.
They spend it. And what do they spend it on? They don't invest. Come on, get off that.
They spend it, well, they spend it on goods, services,
And who provides those goods and services?
Companies.
Okay. So either one, we can give the money to the people in times of crisis who will spend the money and does end up in corporations' pockets, but through economic activity, i.e. velocity of money. Or two, you can give it directly to the corporations and the banks, and they can put it in their checking account.
Yeah, well, here's the reality, and I don't care if you're Democrat or Republican. If you continue this system, you're going to lose.
This isn't a political conversation.
People.
I'm sorry, it's not. Come on, listen. There were Republicans and Democrats between 1980 and 2025. There were Republicans and Democrats between 1930 and 1980. There were Republicans and Democrats between 1787 and 1913. There were Republicans and Democrats between 1913 and 1932. This is not a political conversation. So if you heard this conversation through the political lens, it's not that. This is an economic design. It's bigger than that.
Yeah. Well, I look forward to the market making America have a moment, because that's where I think this is headed.
We have to fix our fiscal situation, and it's not a negative thing. It's not a negative thing.
It's reality.
Like, people have this debt conversation through negative. Oh, you're going to take this way,
right,
this way. No, our GDP can explode 4, 5, 6% if we get our debt under control. You want to talk growth? Stop spending so much money on interest payments.
Final segment, want to do it. Stock it or drop it. I got 10 stocks, Matt, and I'm going to give you a little tidbit on a news story with each of them. And then, so we're going to combine stocks in the news, stock it and drop it. 10 stocks and stock it or drop it. We did this last week. We're going to do it every week, Matt. Get used to it. I loved it. It was just absolutely fantastic. I present to Matt, stock it or drop it. Stock it means, yep, I'm in. And then he can say what time frame, short term, long term. Or drop it. Nope, absolutely not. 10 stocks. I'm going to start with NVIDIA, Matt. NVIDIA made the news this week because it hit the largest market cap. Now, Microsoft might go back and forth a little bit, but I love the semiconductor theme, Matt. I love the fact that China and the United States are playing nice, right?
Mhm.
Huge news, playing nice. In fact, broke today on a Friday morning that China's giving some rare earth licenses to different companies. China and the United States playing nice. It was the only concern I had in semiconductors. Stock it or drop it, NVIDIA, Matt.
Oh no, this is the AI king, queen, and country. This is a stock. Like short term, obviously, you got some challenges on neutrality, but you're gonna want to be here for the 150 conversation. No, I think this is an AI king, queen, darling for the next 10 years. They're going to go back and forth with Microsoft in the short term over the number one company market cap wise, but they've been the AI king for 3 years now. They're not going to not be the AI king moving forward. I absolutely stock it.
Stock it. All right. Next, I'm going to mix this up. We're going to go to DraftKings, DKNG. A little news. Illinois passed a state tax on DraftKings. Bringing this up for two reasons. One, ARK's up almost 10% on a Friday. Absolutely insane. You don't see that every day. Carrying that. Illinois passed a little state tax, kind of weighing on it. DraftKings is one of those leg names that has kind of been out of the news for a while. Pattern's been very, very boring, but it is a popular name. It's a name I follow. Stock it or drop it, Matt.
I drop it. Negative cash flow, free cash flow rate is absolutely ridiculous. The market's been recovering. There's been absolutely no recovery here. Stabilization at the low point. The fundamentals don't scream value, and if you're at the low point, you need to make a fundamental argument. And we just had a conversation for an hour on debt. I think we need to have a little bit more on DraftKings here. So I'd say drop it. It's a good cash flow company though, and it's in a good cash flow situation, but I just think the fundamentals here are a little bit concerning in regards to what the price action is.
Next one is Nucor, NUE. It seems like a million years ago, but it was only a week ago on a Friday night that Trump jacked up tariffs on steel to 50%. Did it after we did the podcast last week. Nucor, 50% tariffs on steel. Kind of a beat up stock here in the material space. Stock it or drop it, Matt.
On Nucor, what specifically on Nucor?
Specifically Nucor.
Yeah, I don't have any interest in Nucor. I'd have to do a detailed evaluation of Nucor versus Steel Dynamics versus Cleveland Cliffs versus some of the other steel companies out there. I do think it's interesting to look at steel companies right now, and I don't have any I wouldn't shame anybody for adding some of these steel companies to the watch list. But the steel companies were up on a specific tariff news that I'm not sure will be a continuation tariff news moving forward. And so I think that's going to be a little bit more sensitive, and there's easier areas of the market, in my opinion.
Broadcom earnings today. I don't know if you've had a chance to look for the number on this
Yeah,
Friday, but
I was
Broadcom,
already bored of them.
Darling, stock it or drop it, Matt.
The downward pressure in price today on Broadcom was because they came right in line with the EPS. Revenue was a positive year over year. On the forward-looking guidance, they basically went up slightly, I will say. Market down here today, but the market's at like an all-time high, and you had momentum going into it. I think this is an interesting conversation, both from a trader's perspective, most likely from a trader's perspective for me, as you see that 250 handle there. I think it's absolutely stock it, even on the short-term side, which is what I'm talking about here, not the long-term side. Let's see what this does on any pullback situation here. I'm looking for a pivot post earnings.
Constellation Energy, ticker symbol CEG, was in the news after Meta signed a 20-year agreement to buy nuclear power. Nuclear stocks, uranium-based stocks have been really, really powerful. I like the story just because it reminds me of the fact that the data center AI energy theme is not dying anytime soon, but specifically on Constellation or Meta, take your pick, stock it or drop it.
I don't have interest long-term, short-term in Constellation specifically, but I am fascinated by the nuclear reactors, nuclear in general, what's happening with the hyperscalers build out with utility companies. So I don't really have interest in parking some money in an energy company, but I am interested in the storyline of how it impacts AI in general, but not Constellation. I wouldn't have any fault with somebody looking at Constellation. I'm just not going to chase a utility company at the top of the chart.
Speaking of data centers, give me Amazon announced its plans to invest $10 billion in new data centers in North Carolina. Stock it or drop it, man.
Oh man, you gotta like what Amazon's doing here, in my opinion. Stock it definitely. Love the technical situation here. Brewing breakout conversation. Snap back after the positive gap out to the 200. Hasn't really done anything wrong. And now you're talking about a potential breakout here. Get that thing dialed in. And Mark, that doesn't look like it wants to do anything besides get back up into the highs on a breakout. So stock it for me on Amazon.
JP Morgan must like the breakout potential. They raised their price target from 225 to 240 this week.
A technical up to the all-time high. I can agree with
Essentially,
that too.
Wells Fargo not having to pay for their sins as much anymore. The Federal Reserve removed some of the penalties on asset caps dating back to 2018. They've been naughty times. Stock it or drop it, Matt.
I have zero interest in talking about Wells Fargo.
There we go. Lulu had earnings today. I don't know if you had a chance to see overpriced yoga pant apparel.
I say
Obviously,
people with concern over the economy might not be buying high-priced Lulu pants right now.
I know.
Hmm.
I never buy.
Listen, the consumer's mixed right now. The consumer's mixed right now. Lulu is a high premium stock with a high premium product and a high premium brand. They got a pretty loyal following, but I got to drop this one. I didn't like the earnings report. Pretty nasty miss here. And they have some negativity on their guidance side of the equation. So no, it's a drop it for me.
Pinterest, JP Morgan upgraded the image sharing platform to overweight. Pinterest, nice little pattern. Stock it or drop
Stock it. You got to like the mid-tier breakout here. I only have a technical thought, and JP Morgan did a price upgrade target from 34 to 40. They are basically trading the same
They're
breakout.
basically trading to the resistance. They're upgrading to resistance. That's all they're doing.
Levels. And it's an upgrade I can get behind. When JP Morgan comes out and be like, we're upgrading this fundamental reason and that fundamental reason, I'm like, yeah, you're trying to sell something is what you're doing. But when they're like, hey, listen, traders, we're going from 34 to 40, who's jumping on board? Yeah, I think they're just doing a technical breakout upgrade. I'm gonna have to stock that one.
I might have to get on board JP Morgan's trade. That's a nice little pattern. Two more for you, Matt. CrowdStrike had earnings this week. Gave back the earnings to my newbie eyes on the earnings. Didn't look too shabby, but stock it or drop it, Matt.
I have not reviewed their earnings, but they shouldn't be too bad. CrowdStrike was at the top, and if they're not gapping down, again, I haven't reviewed their earnings yet. I'm going to do that right after we get done with the podcast. But if they didn't drop, they probably came through pretty decent. CrowdStrike would lose for me to some other cybersecurity firms, but I can't drop it. This is a pretty good, decent situation. Technically, you also got a breakout of that weekly chart with a snapback to that weekly chart. So I can't drop it, but it would lose to other companies from me.
Down today on fake unemployment report numbers, but Dollar General, dollar stores have been trading well. Stock it or drop it.
Stock this one in a heartbeat. Stock it only on a trade setup. I like the trade setup. I wouldn't blame anybody for looking at a little bit longer term. But Mark, when you're looking at Dollar General, it is developing right at a key level of old support, new resistance. That's principal polarity moment. And it could take a little bit of time to dial that in, Mark. But when you're talking about this, it's coming from a very low point on the historical chart. Little bit of development there. I like Dollar General, and I like Dollar General a little bit more than Dollar Tree. From a pure technical development perspective, I like the development. I like their earnings report earlier this week. They're absolutely going to make the bull quick hits for the earnings write up later on today.
Book them down. Send us out, Matt.
Yeah, if you love the podcast, had a little bit of a detailed long form conversation on debt. How do we get there? Hopefully you enjoyed that. I know, I love his history. I love seeing economics through history. I love seeing technical analysis through history. And as Coach Mark knows, I see everything from the behavioral side of the equation. So I really get into those historical economic narratives that we haven't done on the podcast very often recently, but we certainly do. Hopefully you enjoyed the conversation and helped you understand kind of how we got to here and why the conversation on debt is so important here today. If you did enjoy it, hit the like and share in YouTube. Leave a comment as well. And then last, if you are looking to join Master Trader and come hang out with me as we geek out on all things technical analysis, talking about candles, trends, patterns, support, resistance, talking about indicators next week, prepping trades, placing trades, executing trades. That's all Master Trader. You can register for free in the link in the description below. We're doing Master Trader for free this month. So if you want to come join, definitely come do it. It's free. Hit the link in the description below. And I hope everybody truly has a wonderful, wonderful weekend and enjoy the week coming at us as well.
Have a great week, everyone.